Well, welcome to another edition of the Rogers Capital Market Commentary, where we attempt to cut through the noise, the proverbial water cooler wisdom, and give you a clear, concise overview of what's been driving the financial markets, what we're watching closely, and occasionally even splice in some investing principles, all intended to make you a better investor. For starters, what a year, 2025. The S&P 500 climbing 16% last year. Another strong year for equities despite elevated volatility. The index logged more than 40 new all-time highs, driven by resilient earnings and continued enthusiasm around AI, artificial intelligence. Unlike 2024's smooth ascent, though 2025 included a pair of pullbacks, a big Trump tariffs correction in February, March of last year. But each correction was short-lived, was met with strong buying as investors leaned into the AI-powered productivity boom. Mega cap tech remained influential. Leadership for the market kind of broadened meaningfully late in the year as mid caps, industrials, select financials joined the rally. Today, though, we're breaking down 2026, giving you our outlook for the year, the drivers for the next 12 months, how the latest macro indicators help us separate signal from noise. So let's get into it. 2026 looks to be a year marked by volatility, two drivers of volatility. The first being markets are at all-time highs. Equity markets are at near all-time highs. Whenever equities push into record territory, volatility naturally increases. Why? Because expectations get stretched, positioning becomes overcrowded, and even the smallest disappointments trigger these outsized reactions. In fact, we're seeing that now. Tech leadership is extended, momentum is stretched, short-term volatility indexes like the VIX are jumping a little bit, the short, 9-day VIX. Earnings reactions are sharper than usual, but this is normal. This fact is classic late cycle behavior. It's not a crisis. It's not an impending doom, bear market. It's a normal digestion phase after what's been a powerful, a strong run. So that's the first driver, all-time highs. The second, midterm election year. That's right. If I asked you to guess what was the worst year for investors in a 4-year cycle, presidential or election cycle, you got the presidential election, you've got an off year, you've got midterms, and then you've got another off year. If I asked you to guess what's the worst year for investors out of those 4, what would you say? Across nearly a century of market data, the midterm year, you guessed it, this year, the midterm year, has consistently been the weakest for stocks. Why is midterm election year the problem? Well, when policy uncertainty peaks, it's, that's when of course, Congress is pushing through unpopular or tightening legislation on usually the executive branch, the White House. The president's early term agenda can create economic friction. Markets price in political risk, especially House and Senate control. Historically, investors face higher volatility and lower returns in these midterm election years. What about the numbers? Well, if we look back to the 1930s, the lowest average S&P 500 return in that 4-year cycle, 4-ish% in the midterm year. But it's also the highest probability for corrections. President's party almost always loses House seats, in fact, 18 of the last 20 times. And lots of seats. I think the average is 30 plus. And that's why midterm years tend to feel choppy, frustrating, headline driven, the drama, the political drama. Even when underlying it all, we've got an economy that's fine to strong. So markets hate uncertainty, and midterms deliver plenty of that. So when you combine all-time highs and midterm election dynamics, what do you get? You get short-term choppiness, headline-driven swings. We're going to have to turn the TV off for 2026. Turn the Facebook down, turn the internet email headlines down, right? It's just going to be elevated sensitivity to news, to headlines. Let's take a look at the economic and market backdrop, okay, the foundation. Despite the volatility, the underlying economy remains solid. Folks, we have GDP growth at 4.6%. Consumer spending is steady. Corporate balance sheets are healthy. Labor market's been cooling. Inflation's at 2.6%. The Fed's goal or hope was 2.5. The Fed's expected to cut rates down to 3% this year. This is not a recipe for recession. This is normalization phase, okay, after years of extremes. Let's take a look at the macro indicator dashboard. Now, it's infinitely more complicated than this, okay, but these are the signals that the big boys are watching. Manufacturing, okay, PMI index. It's soft right now. In fact, supposed to be at 52. We're like 48. It's soft. I think that's primarily due to the fact that the tariff story is such a question mark. But growth is sluggish, not recessionary. Yield curve, short-term 2-year treasuries being, at rates lower than 10-year treasuries, okay? That yield curve is steepened for us, okay? And that signals a very, easing the recessionary risk, healthier economy moving forward. Core CPI, so that's inflation with energy, oil and gas, and food stripped out, but mid 2% range. Again, we're trying to be at 2.5. We're 2.6, so it's yellow, but that's barely yellow. Inflation's been cooling. Services, wages are a little sticky, but inflation's cooling. Barely yellow, okay? The VIX, the 90-day VIX, low to mid-teens. It's been a little bit higher here recently, and it feels elevated because it was so calm before that. But the volatility index, the VIX, is contained, okay, really despite some of the headlines, which just reinforces that recent swings aren't event-driven or aren't, are event-driven, really, not systemic. Okay, credit spreads, this is probably the more complicated one here on this table, but what is Wall Street doing with risky debt versus safe debt? When those spreads are big, that means they are nervous. Right now, spreads are very tight. Credit markets show no stress. This is one of the, honestly, strongest indicators that recession risk is low. Earnings revisions, okay, you've heard me, I don't know how many times, time and time again. Profits, earnings. When earnings expectations come due for the quarter and we're revising them net positive, forward earnings, okay, right now, improving, that's a green light. supports equities, honestly, even in a choppy market. So, bottom line here, dashboard shows 0 red flags. We got 2 yellow flags, though one is barely yellow. We got 4 greens. Volatility's elevated a little bit here recently, and again, this year should be elevated, but because of positioning and politics, not because the economy is breaking. The foundation is good. We've even, in fact, got some interesting, growth opportunities for 2026. AI infrastructure build out, data centers, cybersecurity, energy demand. Bonds should be an interesting opportunity this year too. How crazy is that to say? But still paying a little bit, and as rates continue to come down, maybe even some appreciation. Healthcare innovations, so from AI-driven diagnostics to hybrid care, there's several interesting, even growth opportunities for this year. 2026, a year where volatility will be the headline, but fundamentals should be the story. All-time highs, midterm election uncertainty, create the noise, but the macro dashboard, the foundation, shows a stable, resilient backdrop. So stay tuned, stay diversified, stay disciplined, stay focused, turn off the TV and the Facebook and the Twitter and the whatever. Process, discipline, okay? Foundation, the signals, not the noise. Happy New Year, 2026. We'll see you next time.